What are the key expectations, Amit?
Suyash, most brokerage firms and analysts are expecting healthy numbers, though net interest margins will be under some pressure due to high cost of funds. And the net interest margins may remain stable QOQ, quarter on quarter, at around 3.4% to 3.6%. Earlier this month, HDFC had announced their gross aggregate advances at 24 lakhs 69,500 crores as of December 31st, 2023, registering a growth of as much as 62.4% year on year. Domestic retail loans jumped as much as 111% year on year and 3% quarter on quarter. Commercial and rural banking loans grew 6.5%. Corporate loans grew 2%. Going forward, analysts expect the bank to have healthy liquidity coverage due to the merger effect. So year on year right now we cannot really calculate, but due to the merger effect, the numbers would be healthy going forward, with return ratios being aided by robust growth visibility in the year to come.
All right, and as you rightly pointed out, the numbers on a year on year basis are not comparable because that are just of HDFC Bank alone, whereas on a quarter on quarter basis they are comparable because they'll include of both HDFC Bank and HDFC. You know, the merger took place back in July 2023. But you know, on the whole, HDFC Bank has a weightage of about 13% on Nifty. So the stock and you know, pretty much banking stocks in general will decide the course of trade in the second half of this session, as the numbers come out only after the market hours. But you know, in the October to December quarter, the Q3, HDFC Bank surged somewhere around 12%, outperforming Bank Nifty that surged about 4% or so. But you know, if you look at the year to day 1 year returns, the stock has largely underperformed the banking index. It's somewhere up around 4%, whereas the banking index, which remember has been a laggard among you know the other sectors, that is up somewhere around 7%. So HDFC Bank has been a relative laggard in a sector that is already underperforming. But to discuss that and more, let's bring on Mr. Sudip Bandyopadhyay, Group Chairman at Inditrade Capital. Sir, thank you for joining us here on News 9. Always a pleasure speaking to you. Now, you know, HDFC Bank, we were just discussing what are the street's expectations, but for you, what are the key variables that you will be keeping an eye out for?
You're talking about HDFC Bank specifically?
Yes.
As far as HDFC Bank is concerned, net interest margin is going to be extremely important to my mind. That we know HDFC Bank is under compulsion to raise a lot of deposits, and that's the reason why I think the cost of deposit has been going up. And how they maintain the net interest margin and how they increase the net interest margin will be something to watch out for. Of course, the credit growth related commentary of the management post the results will be also of interest because there is on one hand they have a deposit mobilization target to meet multiple regulatory requirements and also the loan growth. So we'll have to see how they're balancing that.
Good morning, Mr. Bandyopadhyay. As I see, the stock is down today in the negative at around 0.26%. Now, going by the numbers, apart from net interest margins, what they announced in December, for December 31st, whether it is domestic loans or it is gross aggregate advances or it is commercial and rural loans, all have jumped by big margins. Do you see that as an indicator of a positive outcome in the stock to be performing better than it has performed in the last 1 year?
Well, I have no doubts in my mind that eventually HDFC Bank will definitely perform better than what it has performed in the recent past. The bank has a tremendous potential. I think these temporary challenges which they had post the HDFC Limited merger, the challenge was they had to mobilize huge amount of deposit and also keep the costs down. And that deposit mobilization was required for two purposes. One, as I was saying, for meeting the CRR, SLR kind of a requirements. And the other was, of course, to support the loan growth. See, end of the day, the loan growth and deposit growth has to go hand in hand. You can have a mismatch for a short period of time, and you can bridge that with some other kind of borrowings. But eventually, in the long run, your deposit growth and loan growth rates have to be similar, at least very close. So I think that is what the challenge is. And if they have been able to grow the deposits very well, I'm pretty confident the loan growth also will have been there.